Good morning, everybody, and welcome to this virtual meeting organised by the Department for International Trade on accessing finance for mineral exploration and mine development. Mineral exploration and mine development are expensive and risky businesses. Rio Tinto estimate that 1 in 1,000 greenfield targets becomes a profitable mine. Exploration drilling can cost upwards of $50 per metre. Completing a drilling campaign sufficient to prove a resource may cost tens of millions of dollars. And the development of a mid-sized base or ferrous metals mine and processing plant can cost hundreds of millions of dollars. The idea for this session came from being approached by many project owners over the years who lacked understanding of financing options and what investors require to consider a project. There may be a resource estimate of total mineralization completed in Soviet times for your project, but an investor today looks for an economic resource that considers metals prices and ore grades. You may have an idea of the cost of building a mine and processing facilities, but financiers will want to see a bankable feasibility study specifying methodologies, equipment, and expected recoveries. They also need an IFC Equator Principle compliant environmental and social impact assessment. London is an important centre for mining finance. You may consider Australia for high-risk prospecting finance or the Vancouver Exchange for early-stage exploration equity. But if you're developing a project and looking for serious equity and debt finance, you will definitely find yourself in London. London is a natural access point for Eastern European, Central Asian, and African projects. And London hosts the world's leading finance cluster. 41% of iron ore and 31% of global copper production comes from miners listed on the London Stock Exchange and/or with an UK office. The largest ever public equity raised by a mining company, Glencore, was by the London Stock Exchange. Private equity funds like Appian and Orion, who we will hear from later, hedge funds, investment banks, brokers, royalty companies, and other alternative finance providers, specialty insurers, lawyers, accountants, and of course, our export credit agency, UK Export Finance, the London Stock and Metals Exchanges, and the London Bullion Market confirm London as the home of mining finance. The UK is pleased to partner with top Kazakh financial institutions and the AIX, and we welcome the Astana International Finance Centre. We are fortunate today to hear from leading finance experts from the UK and Kazakhstan. Please have a look at their biographies. I'd like to thank them in advance for agreeing to participate in this session. I hope you will find it informative and useful. And now I hand over to Matt Mullins from Tacoma Strategies to moderate the session. Thank you, Matt.
Thank you. I reiterate what Rosa said in terms of the lineup today in the workshop. This is coming at a very opportune time with the industry showing the resilience that it has over the last couple of months and with good prospects for the future. Matching finance to projects is essential for the healthy growth of our industry, and is particularly important for understanding the vast prospectivity of the area centered on Kazakhstan and matching that to finance, of which, as Rosa said, London plays a key part. We have a great lineup. I hope you enjoy the talks today. Please feel free to ask questions as we go along and to join us at the end. I would like to, with that, hand over to our first speaker, who is Adam Fisher, who's a principal at Appian Capital, and he's going to be talking to us about private equity. Thank you.
Hi, everyone. I'm gonna take some time to talk to you a little bit about Appian, who we are as a firm, what our investment strategy is, and I guess most importantly for the attendees on the webcast, what we look for in our mining investments, what constitutes an attractive investment, and what level of preparation would get you, I guess, most of farthest down track with us as a potential opportunity. So my name's Adam Fisher. I'm a principal in the financial team. We're headquartered in London. Take some time just to talk to kind of our profile as a private equity investor. So we are dedicated to the mining sector. We currently manage over $2 billion in assets under management. That is spread across 2 funds. So our first is fully deployed, but our second, which is around twice the size of Fund 1, we have just closed and are looking to deploy throughout 2020. It's kind of positioned us well to kind of be a provider of financing, during a challenging year such as 2020. To date, we've made 9 investments and we've brought 6 mines into production, with a 7th to be brought into production over the next 12 months. We generally invest in the early development stages of a company, and the value add we bring is really advancing companies and their assets all the way through to production by providing the significant majority of, if not all, of the equity financing required. We have a team of 30 investment professionals. About half of them are technical and operating focused, which gives us a little bit of differentiation relative to other private capital providers in the sector. So, we have people that can, exploration geologists, resource statisticians that build block models. We have mine planners that design and schedule mines, and metallurgists that can help evaluate flow sheets and optimize performance throughout technical studies and then post-production when we're in operation. These are individuals with 20, 30 years experience from some of the biggest names: BHP Billiton, Anglo American, Rio Tinto, AMEC, Barrick. And then you have the other half of the team with traditional investing backgrounds coming from mining-focused teams at global investment banks and private equity firms. What that in-house expertise allows us to do is to be kind of active partners of management teams, kind of all the way through the cycle, advancing through studies. And there are different skill sets at each stage that are generally required to advance a project all the way into production. We believe private equity is a form of capital that is suited best for the mining sector. As we all know, it's a commodity-driven business, and short-termism is this sector is not for kind of the faint of heart that are only looking to kind of get in and get out over the course of 6 months, 12 months. And so, our Fund 1 was a 10-year fund. Fund 2 is a 12-year fund. And what the typical commodity cycle is around 7 years. So what that allows us to do is be able to to develop conviction in the technical feasibility and attractiveness of an operation and back it through the cycle all the way into production, kind of regardless of what commodity prices do in the short term, the short term being anywhere from 6 to 18 months. Here's how we're set up. We're headquartered in London. The bulk of our investment team is headquartered here. That said, we invest globally. We have offices in Lima, Peru. We have a management team based in Belo Horizonte, Brazil. We have an office in Toronto, Canada, and Sydney, Melbourne in Australia, Johannesburg in South Africa. And a bit reflective of where our geographical focus is, but I'd characterize it as a selective global mandate. We're well set up to invest in the Americas and Australia, and we have a lot of familiarity operating in Africa. But that said, it's always on a case-by-case basis. The jurisdictions in which we invest need to be stable, that have kind of well-established track records working with mining companies and facilitating their development into production. Here's a snapshot of the companies that are in our portfolio today. It is a bit of a each has its own story, and kind of I'll go through these, but they are reflective of some of the investment kind of theses that we would look to back. Atlantic Nickel. This is a nickel, copper, cobalt open pit operation in Brazil. We own this 100% and bought it out of bankruptcy. It had an operating history of about 6 years, came into some operating issues. Through our own diligence efforts, we were able to understand what those were and come up with a more defensive operating plan. And this, for us was around a year and a half long restart project. It wasn't something that we had to kind of start from greenfield status. Mineração Valle Verde. This is our other 100% owned operation in Brazil. This is a copper gold open pit operation. It's about halfway through construction. This is around second quartile cash cost position with a scalable resource that in positive commodity environments can grow further. We invested in that one while they were developing the definitive feasibility study. Rox Gold. This is a public West African gold producer based headquartered out of Canada. We own a significant minority position in this company, and we invested when their primary asset, Yaramoka in Burkina Faso, was still in preliminary economic assessment phase. Since then, they've developed that project into a high grade cash flowing asset, backed up with a growth profile supported by the Seguela project in Cote d'Ivoire, which recently announced its own PEA. Hart Gold Corp. This is a Canadian gold producer. Again, we invested in this pre-PEA, so that just gives you a sense of we are able to get involved a little bit earlier than perhaps other investors in the space. When we first invested in this asset, what we liked about it was that they had 30 kilometers of unexplored kind of greenstone belt strike length in a contiguous land package that enabled kind of a cohesive exploration plan and allows kind of an initial operation to scale appropriately. When we first invested in that asset, we were looking at 400,000 ounces in the resource, and have since drilled and defined further up to greater than 2 million ounces of resource potential. Project Kelly. This is our first new investment out of Fund 2. This is in the mineral sand space. What we liked about this asset, again, this is feasibility stage. What we liked about this asset is that it benchmarks well against other producers in the space. So amongst Zircon, another mineral sands producer, it is in the top quartile when you compare the cost positions. So, kind of through the cycle, the cost position of this asset, by virtue of the quality of its deposit, allows it to continue to produce even through cyclical troughs in the commodity space, which is not every year you're in this space you're going to have stable, steady cash flows, but at the very least, one of the things we look for is an asset that through the trough, it will still have sufficient margin to be able to produce through that trough. So idling an asset is something we look to avoid. Because they take working capital to restart, they take capital to mobilize again, to refurbish unused equipment and the like, and that's a scenario we look to avoid with our projects. And then lastly, as a byproduct of our private equity investments, we do collect a stream of royalties, and you know, that they are kind of downside protected cash flowing elements of mine finance that that we find there is appetite for. Although not the primary focus of our fund, it is something we will look to engage in. I'll go through this slide quickly. Appian, we are kind of long-term partners for mining companies. So what that generally means is, you know, if we're not looking to buy an asset outright, what we will do is partner with existing management teams to via a joint venture or an earn-in strategy. And so we're there alongside you for 3, 5, 7 years to advance an asset into production. Already talked through kind of how we've built our team to deliver on that strategy. You know, through technical and operating expertise, and we bring best practice from all our past experiences to management teams as we kind of advance projects. And then lastly, our high level investment criteria is stage. Again, from advanced exploration, at the very least, you're going to need a drill database of sufficient density that allows us to put together a resource, as well as some initial data that allows us to validate certain technical assumptions, whether that's geotechnical, metallurgical, or the like. We will need to be able to create an economic case from the data we're provided in those early stages. Commodity, we're a bit agnostic. You know, our value add comes from de-risking and advancing projects. That said, we do have a preference for precious and base metals. They tend to have deeper markets and you know, stronger or long-term fundamentals. Bulks are a bit capital intensive for us, and the competitive dynamics can be pretty tough with some of the big producers in those commodities. And then niche commodities, you know, such as lithium and cobalt, you know, we're a bit opportunistic in how we engage with those commodities. But our preference is for kind of the core, which is copper, nickel, zinc, gold, silver, PGMs, those types of commodities. Countries, as discussed, selective global mandate, and our preferred structure. You know, in any given investment, we can provide 50 to 300 million in equity funding kind of throughout the life of advancing that project. And then we have a co-investment pool that allows us to kind of go up from there. In addition, you know, part of what we'll help do is tap into debt capital markets as well, or raise project financing. So we're looking at, you know, projects with total capex in the realm of 700 to 800 million that is really kind of within striking distance for Appian at its current size. We do have a preference for private capital structures. It gets away from a lot of the short-termism from publicly listed equities, and there's a lot of time required to invest in a project through studies, through trade-offs, setting, you know, through permitting work streams that a lot of times are, you know, in a private capital structure, you can focus on long-term value and optimization without kind of the noise that comes with having to support a share price every 3 to 6 months. We are active partners, so you know, we work actively, collaboratively across various work streams with our management teams, and so that's what you should kind of expect when working with us. We're very hands-on, and you know, we work together to get an asset into production. On the return profile side, we look at a defensive risk profile. Again, one that can kind of support operations through cycles, growth and upside potential. So you know, we'll invest on the back of a base case that is kind of well defined and supported. But then to the extent there are, you know, the resource itself is scalable, able to deliver more tons into higher commodity prices, or there are satellite deposits that allow you to extend mine life over, above and beyond kind of after the initial operation has gotten into production. These types of kind of asymmetric potentials, it enables us to kind of get excited over and above the initial project scope. And then ability to exit. You know, from what we see, there's a lot of assets that are of a small to mid-size that have a lot of interest from bigger mining companies when they're in production and cash flowing. That said, you know, as the introduction to the conference, you know, stated, there are thousands of projects out there, and so what we need to know from the outset is this going to be of a sufficient size, scale, cash flow profile when fully produced, that it's going to have that appetite from strategics? Because while we're a long-term investor, private equity does need to exit at some point, you know, within a kind of a 10 to 12 year time frame, which is on the long end of our fund. So, but anyway, that gives you hopefully a sense of who we are and what we look for. Thanks.
Adam, thank you very much. We're running a bit out of time already, so we would like to move on immediately to the next speaker to introduce him. Rustin Ospanov is the founder and managing partner of Resource Capital Group. And straight over to you, Rustin.
Thank you very much, Matt. I'll try to be short. A few words about RCG. We are one of very few private investment firms specializing on metals and mining sector in Central Asia, based in Kazakhstan. We are in business since 2012. We have invested in 8 projects so far. Let me switch to another slide. And exited from 3 of them, returning all invested capital to our LPs. We have brought 2 mines to production. We are responsible for an IPO of our portfolio project on the local stock exchange, probably the only successful one for the last decade or so in Central Asia. We have a deep technical expertise and a team of geologists, mining and processing engineers, and experienced legal team with knowledge of local licensing and permitting laws. We usually aim to obtain a majority share or full ownership of an asset, investing at exploration stage. Sometimes we do look at projects at earliest exploration stage, but usually it's advanced exploration stage. Moving on to the next slide. On these slides, there are a few important facts about Kazakhstan's investment attractiveness. The country is doing very well in terms of ease of doing business. It was ranked 25th last year by the World Bank, and you can see that the trend is very positive. According to Fraser Institute, Kazakhstan ranks 15th in terms of best practices, mineral potential, and 24th on investment attractiveness. 2 years ago, Kazakhstan has adopted a new mining code, which substantially simplified rules for acquiring new licenses and reporting standards. We believe that this makes Kazakhstan increasingly attractive mining jurisdiction. Now, the key problem for the metals and mining industry in the country is scarcity of equity capital. Exploration in Kazakhstan had been massively funded during the Soviet time, to put it in a historic perspective. The Soviet government mostly focused on taking large mines to production. Many attractive medium and small size deposits were left explored to a varying extent, yet undeveloped. Since the end of the USSR in 1991, Kazakhstan has experienced shortage of equity funding available to exploration and pre-production stage mining projects. Roughly speaking, 70% of the economy is represented by the SOEs and large major multinational oil and gas companies. So the private sector is very small, and subsequently local private capital aimed at funding exploration stage mining projects is extremely limited. We are probably one of 2 or 3 private investors in the country specializing in equity funding of exploration stage projects. There are a few more diversified local industrial groups looking to invest in mining assets opportunistically. Local and regional majors like Kazakhmys, Kazzinc, ERG most of the time focus on very large assets and would only consider a buyout. As a result, for a mining-focused investor in Kazakhstan, the situation is very attractive. Many pre-explored assets, low competition for targets, create a great market opportunity in our view. Not a great situation for juniors though. So what advice can we give to Kazakhstan-based junior mining companies? Number one, try to display significant potential for the resource size. A medium-sized project is much easier to get funded than a small one. Secondly, aim to be in the first or at least second quartile in terms of cash cost per unit of metal or whatever mineral you're developing. Private investors consider third and fourth cash cost quartile projects are high risk. Thirdly, ensure to have a clear, smart strategy and robust execution, meaning high quality surveying, applying best international practices and producing internationally recognized reports, JORC statement, PFS, BFS. Finally, be ready to make a very attractive proposal to a private investor, given the funding environment at the moment here in Kazakhstan. For instance, globally, on average, founders of a public junior mining company, by the time it gets to production stage, are left with just 5% equity due to multiple rounds of placements, equity placements, and dilutions. So junior miners may want to keep this in mind when talking to private investors. Well, I think I've covered all my points. Thank you very much for your attention.
Rustam, thank you very much. We do have time for one question if anyone would like to raise one. I do have a question in terms of your commodity split. I notice you have a very good suite of projects that you have invested in. Do you have a preference in terms of your commodities that you look at?
Well, our preferences are based on the location of the country of Kazakhstan. We are very close to China, to Western China. So, and China buys a lot of iron ore. They need iron ore and they need coking coal. So we definitely look at those two commodities. Obviously, we also like copper and other polymetallic ores. Zinc, cobalt, nickel. We have invested in copper nickel mine that was later IPO'd by us. Gold, also something that we would look at, and one of the most preferred metals that we would invest.
Thank you, Rustam. A very informative talk, and I'm going to move on to the next speaker.
Thank you.
Thank you. Who is Tamara Gehring. Tamara is head of Western Europe and Nordics primary capital markets for the London Stock Exchange. And without further ado, I'll hand over to you, Tamara. Thank you.
Hello, everyone. Thank you for joining me today on a brief introduction to listing on the London Stock Exchange and how to get involved in the public capital markets. So the London Stock Exchange has a long history of collaboration with Kazakhstan. For over 10 years, LSEC have drawn on our extensive capital market knowledge and expertise to support Kazakhstan's ambition to become a major regional financial center and enhance the competitiveness and sustainability of its economy. Our open access approach supports the development of the domestic capital markets in collaboration with partner exchanges. So let me elaborate and start with how to determine which London market could be appropriate for your project and company. The London Stock Exchange supports a diverse range of projects, large and small. We have various market segments, principally the main market and the AIM market. So the AIM market is a growth market. It's the world's largest and most mature. You're typically earlier in your business cycle and smaller when you list on AIM. So the average listing sizes vary between $30 million and $150 million. However, you may be much smaller or larger, as it depends on your specific case. We have plenty of successful examples of all sizes, really, in mining in Kazakhstan. A nomad or nominated advisor will be able to assist you in your preparation for the listing and will also remain with you as long as you're listed on the AIM market. And they can help you guide through the specific requirements tailored to your project. as well as help you finding appropriate investors. So for the main markets, the technical minimum of listing is £700,000. However, these projects typically have a valuation of at least $100 million US. Again, though, as with AIM, this can largely depend, and an advisor can help you there and advise. Both of the markets benefit from a very deep and international investor pool in excess of $300 billion US. And the next point to consider is whether a dual listing may be appropriate for you. You have two options. You can list straight away on two exchanges, for example, the AIX and the London Stock Exchange. Kazakhstan Prom, which you probably have heard of, I will talk about later, and is an excellent example of a dual listing. Especially if you're a smaller project at an earlier stage, you may choose to list initially on your domestic markets, for example, the AIX, and then progress to London once you're more established and your project is larger. You can move on as either single listing in London or to take a dual listing. For more information on how to list on the domestic exchange, actually the AIX will be speaking after me. We work in close partnership. So then let's move on how to prepare for flotation to access public capital markets. So key themes here are really up-to-date accounts, accurate accounts, corporate governance, along with a strong business case. My previous speakers have mentioned quite a lot about this, on how your project needs to be viable. Your project will need all the required and accurate documentation in place, and basic requirements differ slightly from the different markets. For the AIM market, there is really a lot of flexibility. Like I said, it's the growth market for younger projects normally. No minimum track record is required. However, the company will have to demonstrate the appropriateness to join a public market. For example, one of the things that is recommended is to use an internationally accepted reporting standard as well as accounting standard. Again, a nomad would be able to advise on your specific case. For the main market, generally 3 years of audited financial statements are required, or shorter in case your company is younger and has just recently started to operate, with latest accounts no older than 18 months if there are audited interims included, and 15 months if you include unaudited interims. Accounting standard is generally the EU IFRS or equivalent. So for mining projects, further reports that you may need for your investors, elaborating on what my previous speakers have said, are, for example, the full feasibility studies, competent persons reports, etc. So on the point of corporate governance, this is very important in the public market. So this, as this serves to demonstrate compliance and transparency. As an example, on the AIM market, the best practice for the corporate governance is to follow either the UK Corporate Governance Code or the QCA Corporate Governance Code. I welcome you to have a look and get some guidance from that. On the main market, usually a domestic corporate governance code is applied. Generally, so your business case and your equity story is extremely important. How can you demonstrate this? So a positive equity story demonstrates a clear path to profitability. And generally, just your project will have to have revenues and profits before it lists on a public market. And at the very minimum, it would definitely demonstrate economic viability. Then further to this, really key trends to be aware of are the ESG and green movement that we have seen rise ever more over the last couple of months. So the transition to a low carbon or net zero economy is set to become one of the defining issues of the 21st century. The scientific community has detailed the risks, and many policymakers, regulators, and businesses are really actively taking actions now. An increasing number of companies and institutional investors are recognizing the risks posed by climate change, and with rationale for strong action is really clearer than ever. We know the green economy represents about 6% of the market cap of global listed companies, which is approximately $4 trillion US. With an estimated $30 trillion of assets under management now implementing sustainable investment strategies, investors around the globe are increasingly focused on sustainability. The figure is set to increase with investment in environmental, social, and governance, so ESG in short, based strategies is growing with 20% annually. And sitting at the heart of the world's financial markets, the London Stock Exchange Group is really well positioned to support the global transition to a sustainable, low-carbon economy, including for mining companies. There's really strength of the London markets that we are home to many major global resource companies and our centers for sustainable finance. We are working closely with investors and issuers to encourage the investment in these green industries and support the transition of high carbon sectors. As a first mover in the space, we have launched the Green Economy Mark last year. On the debt side, we have launched the Sustainable Bond Market. Further, we have currently 100 plus of ESG indices, 237 green and sustainable bonds, 78 ESG ETFs, 22 green funds, and 100 plus green companies currently active across the London Stock Exchange. But this has led to us winning the Environmental Finance Sustainable Exchange of the Year Award 2020. The 2020 cohort of the Green Economy Mark has also just been disclosed. We now have 86 companies with a market cap of circa $86 billion across all sectors. The eligibility criteria baseline includes that your company derives 50% of revenues from green business activities. The definition of that is rather large. So by all means, do get in touch and we will look at your case. There may be more green, you may have more green revenue than you actually realize. And on the sustainable bond market, we currently have 237 active bonds and they raised over $60 billion in 17 currencies. And now let me give you some practical examples. Our Kazakh listed universe is very diverse with mining and exploration and production companies across both the main market and the AIM market. Sizes range from just under $30 million to industry titans like Kazakhstan with a 3.6 billion market cap. Kazakhstan is a fantastic example of a dual listing. It is the national operator of the Republic of Kazakhstan for the import and export of uranium, rare metals, and nuclear fuel for nuclear power plants. And so in November 2018, Kazakhstan dual listed in London and Astana on the AIX with a valuation of $3 billion. 64 million out of the 451 that was raised domestically via GDRs and shares offered via AIX. It was the largest EMEA mining IPO globally in 2018, and it was also the first international privatization out of Central Asia since 2006. The IPO followed first ever euro-denominated 1 billion euro bond by the Republic of Kazakhstan that listed on the London Stock Exchange a week earlier. You can see it's all very diverse. And yeah, with that, I thank you very much for your attention and interest. And I welcome you to get in touch with me if you have any questions on how to list on the London Stock Exchange and would like to hear some tailored advice on how to make the best use of our offering for your mining project. Thank you very much.
Thank you, Tamara, for a very good overview of your area on the London Stock Exchange and what it can do to help the investment in Kazakhstan in particular. We'd like to move on to the next speaker, which is Arman Kaliyev, Director of the Investment Department for Tau Ken Samruk. We'd like to move straight on to you, Arman, over to you.
Okay. Thank you, Matt. Good morning, good afternoon, everyone. Today I will present brief information on Tau Ken Samruk and our portfolio projects. And I will mainly focus on Tau Ken Samruk operations with foreign investors. Tau Ken Samruk is a national mining company and is a part of Samruk Kazna, which is a diversified national fund of Kazakhstan with capitalization of more than $70 billion. The mission of our company is to develop mining and metals industry of Kazakhstan through development of investment projects. We aim to be a reliable partner for investors in mining industry of Kazakhstan. And currently, we're focused on joint implementation of our projects with strategic partners for development of new projects in mainland exploration. We also support junior mining companies by providing financial help and technical support in development of their greenfield mining projects in Kazakhstan. On the next slide, I would like to give you information about our projects in our portfolio. As I mentioned, we're open for cooperation on token Samruk projects with strategic partners. So here you can see our zinc, lead, tungsten, and gold projects in different stages of development. So we have 2 gold exploration assets, which consist of 3 licenses on late exploration and mineral resource evaluation stages. We also own 2 tungsten deposits on pre-feasibility stage, one of which is amongst 3 biggest tungsten deposits in the world. It's called Verkhny Karykta. The construction stage is represented by zinc and lead projects. Shalkya is a zinc-lead deposit with combined mineral resources of 7.7 million tons of zinc equivalent. And Alaygor is a lead-silver project with combined mineral resources of 1 million tons of lead. In operation stage, we have silicon metallurgical plant with annual capacity of 24,000 tons of silicon metal, which is mainly sourced by quartz from our Aktas mine. And finally, we have gold refinery plants with annual capacity of 35 tons of gold. For all these projects, investors are welcome. If you're interested in these projects, you can contact us. Here, I'm going to give you an example of token Samruk cooperation with investors. You can see here an example of a fishing partnership with one of the largest metals and mining company. We have built partnership with Glencore in Kazink LP, which is the largest zinc and gold producer in Kazakhstan. Token Samruk completed acquisition of participating interest in Kazink in 2013. And now, for 7 years, we have been benefiting from Kazink business through cash flow, which is paid as dividend. On the next slide, I would like to give you information on exploration licenses in Kazakhstan. During the last 25 years, only significant exploration activities have been carried out in Kazakhstan, and not a single large deposit has been discovered in Kazakhstan. At the same time, Kazakhstan has benefits to conduct exploration activities. The first reason is that mostly exploration programs in Kazakhstan were done at the level nearly 200 meters below the surface. So there is a potential to explore deposits beneath this level. And we also have low exploration cost per square 1 kilometer compared to other countries. And the most important factor is that Kazakhstan has significant diverse mineral resource base. And with adoption of new subsoil use code, we expect significant discoveries in new deposits in the future. On this slide, you can also see interactive map, which is from Committee of Geology of Kazakhstan. As you can see, here is colored blocks, which shows the license which are included in the state subsoil use management program, and they are free from subsoil use. If any investor which comes first and applies for these blocks, the investor who will come first will be in the first queue to get this license. For other areas and the blocks which are not included in this program, license could be granted if investors apply for inclusions of this block in the program, which takes several months, and investors can follow the same procedure as described for the colored blocks. From my point, I can say that with the adoption of new subsoil use code, mining sector has become more transparent in Kazakhstan and more bankable. Now investors can easily buy historical information from Kazgeoinform, and procedures for license application have been improved significantly. On the next slides, I'm going to give you an example of cooperation with international mining companies such as Fortescue Company and Scandi Vanadium Company, which are our partners. And I would like to give a timeline of this cooperation. In the first and second months, there were negotiations, meeting to understand the business structure of cooperation. And finally, we agreed on indicative terms and conditions of cooperation. On second, third months, as you can see, we obtained corporate approval from both sides and approval for signing agreements. And on fourth month, we finally signed term sheet agreements with partners. And after signing term sheet agreements, we moved to the phase of selecting exploration areas and obtaining licenses. Currently, at this stage, we are with the Scandi Vanadium Company. And on the 7 months, we are about to start exploration activities with Fortescue Company. Just brief information about cooperation with mining companies in exploration stages. On the next slide, I would like to share with you with Juniors program, which is aimed at joint development of projects with junior mining companies. We are looking for the projects in exploration stages, as well as project and designing stages in Kazakhstan. Each stage is determined by the balance between return on the investment and the size of the risk and other factors. If you talk about investment amount, Tonkin Samruk is ready to invest in the projects in exchange for participating interest in the projects up to $10 million, depending on the capabilities of these projects. For instance, for exploration, we consider investing up to $5 million on cash-in basis. For project and designing stages projects, we consider from $5 to $10 million. And the return on this investment is planned to be received through the sale of shares or by making IPO or receiving dividends. From my side, it's all. Thank you for your attention. If you have any questions, feel free to contact with me. On the final slide, you will see our contacts, so you can contact me or Nariman, who's Chief Business Director of Tonkin Samruk. Thank you very much.
Thank you very much, Aman. We are going to try and go back to Tim, and I can see you on screen. So Tim, I did introduce you, so I'm going to hand over straight to you. Thank you for coming back to us.
But I thought I'd give you a brief overview of AIFC, which is the financial centre in which we operate, and then what AIX is doing in order to make a more attractive environment for investing in the mining in Kazakhstan. First, my background is very much in the capital markets. I spent 10 or 15 years in capital markets and emerging markets, including doing some work in commodity trading in Asia. I then ran the New Zealand Stock Exchange, and when they approached me a couple of years ago to come to Kazakhstan, one of the attractions has been said this morning by Rustam in particular, but also by Tauken, is the attractiveness of the mining sector. But it's not without challenges, and one of those challenges is, as has been mentioned, how do you get equity capital into exploration, particularly for smaller and mid-sized projects, as opposed to some of the larger projects that have been talked about. So the first step in that process was establishing the right legal and regulatory environment, and AIFC was established in 2015 to do just that. A legal environment which will be familiar to most of you from the UK or Europe, a regulatory environment which was modelled after the FCA in the UK, and a way of doing business that is much more based around an international financial centre than those of you who have experienced working in post-Soviet economies historically. So we have a full legal and regulatory infrastructure, including a court system and an independent arbitration system. Our regulator, as I said, AFSA, is very much modelled on what you'd see in the UK. And as AIX, we were established to start to support the development of a local capital market in Kazakhstan. Our shareholders reflect the fact that we want to bring together the best of what Kazakhstan has to offer, but to deliver international capabilities. Firstly, we use a NASDAQ trading platform. They're one of our smaller shareholders, but we also have Goldman Sachs, who has spent a significant amount of time and effort helping us think through how we can attract foreign capital to Kazakhstan. And our two larger shareholders, both Chinese investors, one the Shanghai Stock Exchange and the Silk Road Fund. The fund that invests in us is specifically dedicated to Belt and Road initiatives in Kazakhstan. And our major shareholder is the financial centre, AIFC. We've been operational about 18 months, and in that time frame, we've established what I consider to be a world-class trading, clearing and settlement infrastructure in Kazakhstan, particularly for a developing market. We have a range of local and international brokers. We have international custodians and domestic custodians. And we have a team that is experienced in running frontier and emerging market exchanges drawn from around the world. However, the challenge for us is not so much the infrastructure, but it's how do we attract companies to list and investors, both domestic and offshore, to invest in those businesses. And the obvious sector for us is the mining sector. As was mentioned earlier on by LSE, obviously Kazatomprom was our first listing and has been quite successful, both in Kazakhstan and in London. But the challenge is, particularly for businesses with a potential market cap or capital raising less than $100 million, you tend to get lost in large global exchanges. So what we're trying to do is to build an ecosystem that supports capital raising for those smaller or junior mining businesses. And the first step that we took in the middle of last year was the development of a specific segment for junior mining companies. We accept companies both with JORG or local reporting. We have developed a set of rules that reflect the nature of the businesses or the nature of the projects within Kazakhstan. And we're in the process of developing what we call an ecosystem of both advisors and potential investors to help support the investment in those projects. We have about 4 companies who we expect will IPO, again, as always, subject to market conditions in the next 12 to 24 months. And we have another 20 projects where they're seeking to raise capital. And I guess unlike most exchanges around the world, we're very much committed to both developing the public capital markets as well as private investment into these businesses. And in particular, we have developed a specific market for private businesses that want to have some of the benefits of a listed environment, including the tax and regulatory advantages. I'll leave it there. Happy to answer any questions, and thank you for your patience in terms of some of the technical issues we had.
Tim, thank you very much for that extremely informative talk. We do have time for 1 or 2 questions. Perhaps I could kick off and ask if you have any preference for size of company that you would look at in terms of a listing.
Yeah, look, as I said, if you think about global capital markets, what you tend to see now is a bifurcation where larger businesses of, say, $200 to $250 million of market cap tend to gravitate to global financial centres. And that's particularly true in mining. So, and London or Sydney are the obvious places for that. But when you get below that, you tend to see businesses seeking a local investor base and a local marketplace. And the reasons for that are, firstly, local knowledge, and secondly, the ability to generate local liquidity. For those smaller businesses or projects in global financial centres, and we've seen this with a number of Kazakh businesses that have listed in London over the years, you tend to lose liquidity, you then lose research coverage, and you end up with a very illiquid stock, which arguably doesn't provide a good valuation on the business, nor gives that business an opportunity to raise additional capital. So our sweet spot really is trying to gather, as I said before, both private and more traditional public investors for businesses that are valued at less than a couple of $100 million. And it'll take some time to develop that ecosystem, but that's clearly our area of focus.
Tim, thank you very much. And I look forward to the discussions at the end of the session today, and hopefully you can stay on for that for further questions. I'd like to move on to the next speaker, who is Ozge Kutay. He's the Chief Representative in Central Asia, Eastern Europe and Turkey for UK Export Finance. Ozge, thank you very much. I'm going to hand over to you straight away.
Hi, Matt. Hello, everyone. Good morning, good afternoon. And I'm very pleased to be part of this presentation. And I thank to all the organizers. I may probably start with my next slide, to have the first bit of information. But essentially, UK Export Finance has been in business for over 100 years. We were set up in 1919. And since our establishment more than 100 years ago, we've been a UK government department working alongside with the Department for International Trade, the IT, and the Treasury in the UK. And obviously our offer, which I'm going to explain in detail shortly, we work with the private industry, private lenders, mostly banks, investment banks, commercial banks, and some credit insurers, to make our offer more sort of attractive. We were named as the best ECA or the most admired ECA by, Global Trade Review, Trade Finance Global. These are the Euromoney equivalents for the ECA industry, and we're one of the most probably preferred ECAs due to the attractiveness of our offer. Let me start with maybe for the benefit of the general crowd to describe what is an ECA. An ECA is an export credit agency, and by definition, it's usually a government-owned or sponsored institution with a sovereign status. So we're, as UK is part of the OECD, we're also part of the club with other OECD ECAs, and therefore we work along the same basic parameters which are governed by the OECD arrangement with these 30 or odd other country ECAs. While most of our, or some of our features in our offer are very similar and governed by the OECD, there are some others which really we think differentiates us from the rest of the sector, our peers. I'm going to sort of go over them during the presentation. Now, our mission as a UK government department is obviously to help the UK exporters. And if we really explicitly go with it, our mission is that no viable UK export in goods and services fails due to the lack of finance or insurance, of course, at a no net cost to the taxpayer. So as the mission implies, we support the exporter, and we try to do it in conjunction or along with the private financial industry. So we don't see ourselves as a competitor or a substitute to the private industry. So we work with them, we rely on them as well. And in areas where commercial or raising commercial financing becomes very difficult, or it becomes very expensive, or it becomes very short tenor, then we believe our offer will make more sense, provided that there are sufficient level of exports, UK exports, into the project. And maybe we can move to the next slide. Just a review of the past fiscal year, we had provided £4.4 billion in support, and we had connected with 500 companies, these are UK exporters, for various international opportunities at our supplier fairs, where we really market a project using our strength of our offer as well as our network to the UK exporters, for them to have the chance, that they can export to that project, and that can also make our financing possible. In the past fiscal year, we were able to support 339 companies in the UK as exporters, which export to 69 different countries. And if you look at the entire volume of business that we've done that is outstanding, it's about actually 30 billion pounds, and we are operating under a 50 billion pound global market risk appetite, which means that there's a good 20 billion of financing available in one way or another for the eligible projects. We are usually sector agnostic, what we call ourselves, as our mission implies. We support UK exporters from all companies, all sectors, all industries, and it can be any country. In the context of this discussion today, in particular to mining, we could do different ways of financing. We can support the project itself, the buyer credit, which is known in the industry, where the buyer, actually the importer, which is usually sponsors the project or is a contractor in that project, or it's the government that owns that project in a particular country, we arrange financing to them in exchange that they buy from the UK at a sufficient level. Maybe we can move to the next slide to go over, what sort of an offer we can do. Firstly, although most international financing occurs in hard currencies, what we call the dollars, the euros, the pounds, and Swiss francs, yens, we could do it in 60 plus local currencies. So our guarantee that we provide to the bank that funds this project can be in 60 plus local currencies. That covers Kazakh tenge, that covers Turkish lira, and several others from the Eastern Europe, Central Asia region. But essentially, it's 64, I think, in the exact number. And the point here is that it's not only confined, to the hard currencies. Now, we were able to, in our past history, to support UK export in or to over 200 countries. So if you go to our website, www.ukexportfinance.go.uk, you will be able to see our country limits equivalents, which are the market risk appetite, we call them. They are basically indicators, and I'll give some numbers away since we have a crowd, an audience from Kazakhstan mostly. We do have around 2 to 3 billion pounds of capacity for Kazakhstan, and as large for Turkey. And our entire appetite, let's say, for the region ranges around 15, 16 billion pounds for all the different, 14 countries in the region. Maybe we move to the next slide. What is exactly in our offer? So I mentioned the currencies, and how our offer works is the number 3 from the top, and we provide 100% unconditional guarantee by the UK government, by HMG, to 85% of the total contract value, which means for the banks that are going to fund this project under our guarantee, the project risks really turn into a UK government risk. So that makes it bankable, longer tenors, more cost efficient, and more doable. The other example is the tenor. We could do 2 to 10 years. For some select sectors, we could do longer than 10 years, including aircraft, rail, nuclear power, renewable power, which are not including mining, unfortunately. But the good news is that the investment period, which could be long, right, which could take months, years, which we call our disbursement period of using our facility under the loan, that is not included to that. So to be exact, for a project that has an investment, like a construction or building, let's say, period or development period of 3 years, our loan can be as long as 3 plus 10 years to fully have it repaid. Now, for that, we require, for the amount under consideration that we're going to look into financing, we require around a minimum of 20% of UK content. And that UK content can be goods or services, which I'm going to give some examples. One of our strengths is we work with a number of, as I mentioned, with almost 70 different institutions, and some of them are truly global. We don't have to work with a UK bank. We can work with all the lead international banks to arrange or to fund the facility under our guarantee. And these range from the American banks to UK, continental Europe, In the region where we're talking about, in Central Asia, we know that some continental European banks and some Japanese banks are more active. We're happy to work with them. Now, as government officers, we cannot really formally suggest a bank to you, but we can say that we were able to work with these banks in those countries, and you're happy to talk to all of them. The other advantage is that there is a competitive pricing, because the bank, rather than taking the country risk of the country where the project lies, let's say it's Kazakhstan or Turkey, it really takes the guarantee, which is the risk of the UK government, which makes it obviously very, very affordable from the buyer's point of view or the project sponsor's point of view. In exchange, like other OECD peer ECAs, we do charge an insurance premium, which is, again, calculated on the same basis across all OECD ECAs. So it's very transparent. It's on OECD website. It's called OECD ECA Premium Calculator. And in order to really juggle around and find some indicative pricing on the insurance premium, you need to know basically 2 or 3 things. If it's a government project, government-sponsored project, it's very easy. You look at the OECD rating of that government, 1 to 7, 1 being low risk and 7 being highest risk. Kazakhstan is 6, Turkey is 5, I believe. You need that. The second one is the development period, or the time in months that will take the loan to be dispersed. And finally, the repayment period, which we call the tenor, conveniently among us bankers. So if you have those 3 items, you can plug in and calculate the rough insurance premium. The good news is that we can finance that insurance premium. So we can add that insurance premium on top of the financing that is required, and you then pay it in due course and equal a number of months that the loan is outstanding. In terms of eligibility, in the next slide, if we move to the next one, just to stress, we require a minimum threshold of 20% UK content. And I stress that because we don't average 21%. Our average is about 40%. So based on limited resources, obviously, we're inclined to support higher content, higher UK export content projects, over the lower ones. And on average, we achieve, I think, a 45% of UK content as a percentage of the financed amount that we considered. So that really, leaves the question that while we're looking after the structure, the financial structure, I think there's an equivalently important work stream that is on the commercial part that needs to be taken care of in the run-up to the project financial closure, because the higher the better for us. You heard from the earlier speakers, and it is of utmost importance to have the environmental, social, and human rights due diligence processes. And for that, we hire outside consultants at the expense of the project sponsor or the borrower. So they provide us, and they don't have to be, again, UK firms. We are okay to work with internationally accepted firms. The bank must be acceptable to us. We need to have some, working level arrangement with them. It doesn't have to be, in writing, but at least some joint experience makes things more sort of smoother to be able to execute. So it's very important. For some of the geographies, there are not that many in our region, in the Eastern Europe and Central Asia region, but the sustainable lending rules may apply. These are rules governed by UN Development Program, UNDP, where they consider some of the countries as countries of extreme poverty. So we need to go through a certain other set of rules or checkpoints to decide whether we can do that or not. And then, as I said, there is our country cover policy and market risk appetite indicators that are available on our website. If we move to the last slide, the good news here is that our offer very low, at 20% minimum, that really differentiates us from the rest of our peers. It's one of the lowest. I don't know any other ECA that requires lower than 20%. And the other good news is that we accept both goods. And when we say goods, these are goods produced or processed or modified within the UK and eligible for a UK country of origin certificate. And these could be capital goods or, for instance, mining equipment, that is going to be used in the mine. Services are equivalently acceptable, and we would consider them. And we're very flexible sometimes on the intangibles, whether it's intellectual property rights or some licenses and things of that nature, and profit due to this project, we can also count under our UK exports. Now, to summarize, I think that we believe that our offer is very attractive on 3 fronts: the low UK export requirements, the flexibility between goods and services, and ultimately, since our guarantee comes from the UK government, and it's a guarantee, not an insurance or so it's very acceptable by the funding banks. Now, maybe last word on this. Obviously, and we heard from all the participants so far, that the mining industry, especially if you're developing your own mine, has a number of risks. It is usually not an industry that is the most beloved by banks, right? I mean, it doesn't come as manufacturing of foodstuffs. It is seen to have some venture-related risks. So with that, we really pay more attention on mining projects. Now, if they are government-owned, government-sponsored is one thing, because we don't really take the operational risk of the mine, but we rather take the country risk or the government risk of that particular country. So it's a formal sort of a purchase of mining equipment. We're happy to look at it. But when it's a private establishment, a project financing scheme, which requires that the loan is repaid through, the proceeds or the revenues from that project, obviously there are a number of risks, right? There are risks related with the development. The development cost should be low, or at least more economical in the sense compared to the other examples, or under control. So as any other bankers, we don't like surprises that much. We are going to be very keen on low and predictable operating costs. We will pay extra attention on market risks, because when the mine really extracts whatever it's gonna extract, is there a market for that? Who are you going to sell it to? Is there an off-taker? The commodity prices, right? If it's linked to any commodity price, these are going to just bring in additional uncertainties. So we would be extremely careful in looking at them. And one of the mitigating factors to all these risks is having a higher equity level compared to any other project finance, because that equity, and we heard from both private sector as well as private equity as well as the publicly listing side of equity. It would be a good way to have an equity buffer to be able to talk for debt financing. Now, our earlier experience really showed us that the financial model should be quite robust, with good assumptions that will be all tested, with downside scenarios that can be explained, and with enough sufficient level of mechanisms that would prevent any failure. My last word: it's better to engage with us earlier, and it's better to approach, if you are doing a project of your own, a full-fledged information memorandum with an advising bank, and then approach us. Thank you very much.
Thank you, Ozgur, for that extremely interesting talk. And I hope that you're going to stay on for the Q&A session at the end, because I'm sure there will be many questions and comments to you.